Ever wondered why your insurance premium looks completely different from someone living just one state over? You're not alone, and today we're breaking down exactly why insurance pricing varies so much by state. Welcome to Insur Knowledge, where we make insurance make sense. In this episode, we're exploring how regulation, risk, and market competition create very different pricing realities from one state to the next. Let's dive in. First off, insurance isn't priced nationally the way some people expect. Even though big carriers operate in all 50 states, they can't just copy and paste pricing from New York into Kansas. And that's because of one simple truth. Insurance is regulated at the state level. Each state has its own insurance department, its own rules, and its own approach to how companies can price, file, and market their products. Some states are called prior approval states, where insurers need to submit rate filings and get approval before changing prices. Others are file and use, where insurers file new rates and then start using them after a waiting period. This difference in regulatory oversight creates big variations in how quickly insurers can respond to market conditions, claim trends, or catastrophic losses. If a state has a slower approval process, insurers might need to bake in more uncertainty into their pricing, making rates higher just to stay safe. Now let's talk about risk. Every state has a different risk landscape. Think about it. Homeowners insurance in Florida needs to factor in hurricanes. In California, it's wildfires and earthquakes. In the Midwest, tornadoes and hail. Auto insurance in densely packed urban states like New Jersey or Illinois will face more frequency and severity in accidents than rural Montana. And it's not just nature. Litigation risk also plays a big role. If one state has a track record of high-dollar lawsuit settlements or aggressive plaintiff attorneys, you better believe insurance rates in that state are going to reflect that exposure, especially for lines like general liability or commercial auto. Now let's add another layer: market competition. Some states have tons of insurance carriers fighting for business. Others, just a few players. The more competition, the more pricing pressure to win customers. That's why in more saturated markets you might find cheaper premiums even for similar risk. But in states with limited competition, or states where a few carriers have exited due to heavy losses, you'll likely see higher prices, fewer options, and stricter underwriting. A great example of this is what's happening in California and Florida. After multiple years of huge wildfire and hurricane losses, several major carriers have pulled back or paused new business in those states. With fewer players in the market, prices go up, and regulators often don't allow insurers to increase rates fast enough to cover rapidly changing risk, which creates a pricing squeeze and tightens availability. Meanwhile, in states like Texas or Georgia, the market may be more open and dynamic, with more players willing to price competitively due to different regulatory and risk environments. Another wildcard? Reinsurance costs. If a state is viewed as high risk by global reinsurers, think Florida's property market or Louisiana's flood zones, the cost for insurers to buy reinsurance coverage in those states spikes. And that reinsurance cost ultimately gets passed down into consumer premiums. So when reinsurers raise their prices after a catastrophic year, you'll often see state-specific impacts on insurance rates. So what does this all mean for the average consumer? Well, just because your premium went up doesn't mean you did anything wrong. It could be a change in your state's regulatory filings, a major loss event in your region, new legal rulings affecting claims payouts, fewer insurers offering coverage where you live, or your state simply being re-rated as riskier by carriers or reinsurers. And as climate change, social inflation, and regulatory pressure continue to evolve, we can expect state-by-state disparities in insurance pricing to grow, not shrink. So what can you do? First, understand that shopping around matters, especially if your state's market is competitive. Second, talk to independent agents who understand your state's regulatory climate and insurer appetite. And third, stay informed, because the more you understand about how pricing works, the better positioned you'll be when it comes time to renew. Thanks for tuning into this breakdown from Insur Knowledge. If you found this helpful, hit like, subscribe, and drop a comment. If you've seen your rates jump recently, let us know what state you're in and what changes you've noticed. We've got plenty more videos coming up to help you understand the why behind your insurance costs and where the industry is heading next. Until next time, stay informed, stay covered, and keep learning.